Welcome back to Investing Talk Podcasts. Today we're setting our sights on OSCR Health, a company that represents, well, a really compelling case study at the intersection of healthcare innovation and the unpredictable currents of the financial market. They recently hit a monumental financial milestone, only to face a pretty dramatic reversal this past week that sent some shockwaves through the industry. Our mission today is to unpack what makes OSCR Health unique, delve into the remarkable financial turnaround they've managed, and then, crucially, try to unravel the mystery of what happened just this past week. Why did their stock price plummet, even after reporting seemingly strong earnings? We want to give you the full picture, help you truly understand the layers of what's unfolding here. And as always, if you find this deep dive valuable, informative, please consider subscribing, liking, and leaving a comment. Your support truly helps us bring more of these insights to you. And if you're feeling extra supportive, you can always buy us a coffee. So let's start at the beginning then.
For those of us who might not be intimately familiar with, well, every player in the healthcare space, what exactly is OSCR Health? How do they fit into this complex landscape?
Right. Well, OSCR Health is primarily a healthcare technology company specializing in health insurance plans. They cover individuals, families, and small businesses, largely operating through what's known as the Affordable Care Act, or ACA, marketplace. For listeners maybe not familiar, think of the ACA marketplace as an online exchange where individuals and small businesses can shop for health insurance plans, often with government subsidies actually making it a pretty critical arena for insurers.
Okay, that clarifies the playing field a bit. But in a sector dominated by these long-established players, what truly sets OSCR Health apart? What's their, unique value proposition?
Well, their core differentiator isn't just offering health insurance. It's about a deeply tech-driven approach. That's the key. They leverage data and digital tools not just for, say, administrative efficiency, but to genuinely try and enhance the member experience. Imagine an app that doesn't just help you find a doctor, but maybe proactively reminds you about preventative care, simplifies complex billing, or offers virtual consults to sort of triage issues before they escalate into expensive ER visits. Features like $3 medications aren't just marketing. They're an example of how OSCR's tech aims to improve health outcomes and maybe reduce long-term costs by encouraging medication adherence. They've also expanded into employer-sponsored programs and these multi-condition management solutions, all powered by their own proprietary tech stack for better member engagement and operational efficiency.
So it sounds like they're really trying to inject a bit of Silicon Valley thinking into a notoriously traditional industry. Who's at the helm of this tech-forward strategy?
Mark Bertolini is the CEO. He's widely recognized for driving innovation, particularly from his impactful time as the former CEO of Aetna. So he brings a pretty seasoned perspective to OSCR's disruptive model.
It's clear they're a challenger then, aiming to disrupt the status quo. They're not one of the decades-old giants we often talk about, are they?
Precisely. No. While they've experienced rapid growth, they definitely remain smaller than established players like Centene or Molina Healthcare or, the industry titans like United Health Group. Their strength really lies in that rapid revenue growth rate and their distinctive digital-first member engagement strategy. That kind of positions them as a more agile, modern alternative.
And this innovative approach, it clearly paved the way for something truly monumental on the financial front recently.
Yeah.
What exactly was that game-changing milestone? How did OSCR manage to pull that off?
They absolutely did achieve something huge. OSCR reached its first ever annual profitability in fiscal year 2024. This is a massively significant milestone for a company that had previously been, consistently loss-making. To put some numbers to it, they reported $25 million in net income, which translated to about $0.10 per share, and their adjusted EBITDA was $199 million. This financial pivot, it wasn't accidental.
Wow, that's a dramatic shift, isn't it? From burning cash to actually generating profit.
Yeah.
What strategic levers did they pull to drive this turnaround? What was behind it?
Several factors really converged. Their revenue hit a record high, $9.2 billion in FY24, showing a remarkable 56% year-over-year growth. Now, this surge was largely driven by significant membership increases during those open enrollment periods. They expanded their base from about 1.45 million to over 2 million members in just the last year. But it also came from a real laser focus on refining their underwriting, actually exiting some unprofitable markets, and leveraging their technology to better manage the health of their members. That directly translates into a healthier medical loss ratio. It's been a kind of a masterclass in operational efficiency efficiency in what's usually a very high-cost industry.
Okay, and looking at their most recent quarter then, Q1 2025, how did that stack up against this impressive full-year performance? Did that momentum continue?
It did, yeah. Q1 2025 results were also remarkably strong, really affirming that this wasn't just a one-off. Total revenue was $3.05 billion, up 42% year over year. Net income attributable to Oscar soared to $275 million, nearly tripling from the prior year. That's huge. Their earnings from operations were $297 million, a substantial increase. And crucially, they continue to show improved operating efficiency. Their medical loss ratio, or MLR, improved slightly to 75.4%. Now, think of MLR as the percentage of premiums an insurer pays out in claims, so a lower number generally means more profit margin. At the same time, their SG&A, that's selling, general, and administrative expenses, that ratio significantly dropped to 15.8%. That indicates they're becoming much more efficient at managing overhead. Both are really strong indicators of improving operational health. Their EPS for Q1 2025 was 92 cents, not comfortably beating analyst estimates. So yes, a clear, strong trajectory of growth and improving financial health.
Okay, so on paper, Oscar Health looks incredibly strong. Consistent growth, now profitability. You'd absolutely expect their stock to be celebrating, wouldn't you? But here's the curveball, the really interesting part. Despite these stellar individual results, the stock took a massive hit just this week. What is the disconnect here? What happened?
It's a fascinating and probably frustrating dynamic if you're an investor. On July 2nd, Oscar Health stock experienced a really sharp decline, closing down 18.7% at $16.62. This was a significant underperformance compared to the broader market and its sector peers. Just a really tough day.
An almost 19% drop in one day is staggering, especially, like you said, right after such positive earnings reports.
Yeah.
What on earth triggered such a dramatic shift?
It seems like there were two main factors, and both really stemmed from external industry anxieties, not Oscar's own performance directly. First, fears kind of reemerged over potential CMS audits. That's the Centers for Medicare and Medicaid Services. Audits can always impact profitability in this highly regulated space, so that worry resurfaced. Second, and arguably more impactful, were analyst downgrades that followed sector-wide concerns. And this was triggered after Centene Corporation, a major competitor, made a very surprising move. They withdrew their own earnings guidance.
Centene withdrew guidance. Okay, what exactly was that about, and why did it ripple through the industry and hit Oscar, even though, as you said, Oscar's own results were so strong?
Yeah, Centene pulled its guidance due to unexpected issues with something called risk adjustment data in the health insurance marketplace. Now, this is a complex but really crucial system in the ACA marketplace where insurers basically exchange payments to balance out the financial risk of sicker versus healthier enrollees. If a company takes on sicker members, they might get a payment from this pool. If they have healthier members, they might have to pay in. Centene specifically mentioned unexpectedly high morbidity rates among their marketplace enrollees, meaning their members were sicker than they had projected. This basically threw off their financial models, and it immediately raised these widespread concerns about the accuracy of these risk adjustment payments across all insurers operating in the ACA exchanges, and that includes Oscar Health.
Right. So even though Oscar Health's own financials were robust, they just reported fantastic individual results, the market reacted primarily to these broader industry fears, and specifically a competitor's very specific and frankly unsettling issues. That almost feels like Oscar was unfairly punished for someone else's problem.
Yeah.
Does that happen often in this industry? Is it that interconnected?
It's a key lesson, I think, in how interconnected the market is, particularly in highly regulated sectors like healthcare. What happened with Centene, it triggered analyst downgrades across peer companies, including Oscar, because the concern wasn't just about Centene. It was maybe about the underlying mechanism of risk adjustment that applies to everyone in that market. Plus, additional pressure came from these renewed fears around regulatory reviews by CMS, targeting ACA marketplace participants specifically. All of this just significantly overshadowed Oscar's otherwise strong quarterly results. And you saw the market sentiment on social platforms quickly shift from, pretty positive to one of heightened anxiety. It shows how broader headwinds can really influence even fundamentally strong companies.
Okay, this brings us to the bigger picture then. We've highlighted Oscar's strengths, that first full year profitability, the robust growth, improved efficiency. What are the ongoing risks investors need to keep in mind for Oscar Health, especially after this recent market reaction.
Yeah, beyond the immediate shock we just talked about, several risks definitely persist. Regulatory changes affecting the ACA marketplaces or maybe Medicare reimbursement could directly impact enrollment or profitability down the line. For instance, what if CMS tightens regulations specifically on how those risk adjustment payments are calculated? That could potentially squeeze margins for ACA insurers across the board. There's also intensifying competition. You have legacy insurers, but also newer insurtech entrants kind of nipping at their heels. Can Oscar maintain its competitive edge on technology, or does it become more of a race to the bottom on price? The medical cost trend is always a concern. If claims come in higher than projected, that could easily compress profits. And another point worth noting is that actually, prior to this recent drop, Oscar Health's stock was trading above the consensus analyst targets, which were around $18. That suggested maybe a potential overvaluation risk if market expectations aren't consistently met going forward.
So despite their strengths, they're navigating a real minefield of external factors. What about the flip side? Opportunities for Oscar Health to continue its growth story and maybe bounce back from this recent volatility.
Oh, opportunities certainly exist. They can pursue further geographic expansion into new counties or states. That's expected to drive additional premium growth, maybe in early or mid-2025.
Yeah.
Also, new product launches, especially those targeting chronic disease management, could significantly boost member retention and potentially improve their margin profile. Their tech-driven approach could really shine there, offering highly tailored programs that benefit both the member and Oscar's bottom line. That's kind of their core promise.
So putting it all together, what does this all mean for someone trying to understand this complex intersection of tech, healthcare, and finance?
It's a lot to process. It is. Oscar Health undeniably represents a compelling turnaround story within health insurance technology. I mean, achieving their first profitable year while maintaining that robust revenue momentum, that's genuinely a testament to their tech-enabled disruption strategy in a very traditional industry.
However, as we've seen so clearly this week, it's operating in a highly scrutinized and really competitive sector. The recent stock movements just highlight how susceptible even fundamentally strong companies can be to these broader industry headwinds and regulatory concerns. They can shift market sentiment almost overnight. It's almost like Oscar built this great rocket ship, launched it perfectly, achieved orbit, but then a sudden storm blew up in the entire space industry, and everyone got grounded, regardless of their individual flight plan.
That's a good analogy, precisely. So based on the current data, for most investors, this probably suggests a prudent stance right now, maybe hold. It's about maintaining positions if you're already invested and perhaps waiting for further evidence of sustainable margin improvement or maybe more attractive entry points after this drop. Now, for risk-tolerant investors who are specifically seeking high-growth disruptors, maybe modest allocations on pullbacks could be considered, but continuous monitoring of those competitive dynamics and regulatory developments is absolutely advised. It's not a set-it-and-forget-it situation.
Okay, here's a final thought for you, our listeners, to mull over. Given Oscar Health's recent stock volatility, driven seemingly more by these sector-wide concerns and regulatory fears than their own strong financial performance, how much does the broader market narrative truly dictate the fate of innovative companies, even when they hit major milestones like profitability? What does this teach us about distinguishing a company's individual strength from the powerful, sometimes irrational currents of industry-wide challenges? Something to think about. That's our deep dive into Oscar Health for today. We really hope you found these insights valuable. Until next time, stay curious and keep learning.